The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block. With your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tusaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
And welcome to today's episode of The Option Block. This is Mike Tusaw, guest hosting and trying to fill the enormous shoes with which will never be filled, but always trying to anyway, of Mark Longo. He is out on assignment today. And with us, we have our usual
Mark Longo. The only thing bigger than Mark Longo's shoes is his neck. I don't know if you've ever seen that guy's neck, but he could give you a run. You and Longo could have a neck off, and I'd be real interested to see who would win. So.
And with that, allow me to introduce the greasy meatball sandwich himself, Dr. Mark Sebastian.
I'm not a doctor. I only play one in my own mind.
There you go. How are you today, Mr. Seabass?
No, I'm doing good. Just kind of relishing in the market today. It's interesting. When commodities rally, it's bullish for the market, and when commodities fall, it's bullish for the market. So, who knows? So, fun day.
Very good. And in our rotating chair from the Options Express World Headquarters over on Monroe Street in Chicago, we have Mr. John Griegas. John, how are you today?
Doing good. Just trying to play catch up to all these commodity moves over the last 2 weeks and raising those margins.
There we go. That's the way to keep commodities in check.
You can trade silver. You just need $40,000. I know it was $11,000 5 months ago, but it's pretty much quadrupled in price. But no, I mean futures options have been the focus here for the last 2 weeks. That and of course our rollout of Forex. But we'll get to that more later in the show. But good to be on. Miss you guys.
Sounds good.
We missed you too.
We do. Well, I'm going to lead the show off today by hitting myself in the head a couple times. All right. And Cisco is one thing that we've been talking about, and that's one that I've stayed in through the earnings announcements, and I am man enough to admit when I'm wrong. So with that, with Cisco, it's one to where I was hoping that the earnings announcement would give the stock a little bit of a boost. Obviously, it did not. One thing that I'm looking at with Cisco, I'm looking to start to scale out of the position a little bit, not necessarily because of the price movement that happened. The price movement's not much of a factor. Obviously, it went down, but what's concerning me more about Cisco is just after going through the conference call and reading through it, just the comments on it are just along the lines of, well, things are going to be tough for a long time. Thanks for your support, shareholders. They didn't really even try to spin it to the upside, and that's one thing that's probably most concerning to me about Cisco. So not quite 100% sure if we're going to continue to stay with it for now, but nonetheless, I am man enough to admit when I'm wrong, and I wanted to start the show off with that one. You guys have any thoughts on Cisco?
I like the stock almost as much as I like the rapper. All right? He was great in Mystery Man back in 2000 and and 2, but since then hasn't really done much. Sounds a lot like Cisco the company. So they're very, very similar, actually. So that's my thoughts on Cisco.
Gotcha. Mr. John.
Yeah, I've been long Cisco since the first time it dropped below $20 too. So, I'm hurting a little bit myself, and I watched the earnings come out. It did pop in the aftermarket yesterday. Was trading around 18 handle, I think, right? I mean, it was.
Oh yeah.
And I felt a little redeemed. I go, all right, there you go, and didn't get a chance to read the news, release, but I woke up this morning down 3%. Watched it just trickle lower pretty much the rest of the day, and it. Man, down 4, almost 5%, 16.93 on the close. I think it had a low of 16.64. So, I have all these rules in place about stops and exit points, and a mental stop. It blew right through my mental stop today, and probably looking to get out here soon to just cut my losses. I believed in you, Tusa, and you let me down.
Hey, I'll try and do better next time. But, I'm not giving up on it yet. I'm still going to give it another day or two to just do some further examination. I'm not one to be extremely hasty on things, but nonetheless, I am man enough to admit when I am wrong. So, on that note, let's talk about silver. With that, one thing on silver that I know I've been talking to folks about, we were long the 40 puts on silver, and we stayed long the 40 puts on silver for quite a ways down, actually. So, that's one where, silver has big moves to the upside. They're going to have big pullbacks as well. On it, we actually rolled down this past week from the 40 puts to the 33 puts. So we were able to capture a little bit of upside on it, and then we've sold a couple of calls in between, so where it's almost, it's starting to work out for us in a pretty good way. We're starting to build up the collar a little bit more now to where we're having upside again on it. So we're excited about the opportunities along those lines, but I got to say, this is a lot more than I bargained for 2 years ago when I was trying to do a simple collar on silver. But nonetheless, it's been a lot of fun, and it's been a good thing to be a part of, obviously, and it's just one thing that if you're going to trade something like this in a long-term account, by gosh, you better have some puts in place. At least that's my humble opinion. What are you guys seeing in silver these days?
Well, we're seeing at Options Express a lot of people that aren't trading it anymore. I got a lot of people that are unhappy. I mean, not to give specifics, but I had one conversation with a gentleman, and I talked to him last week, and his account was debit. Okay, and that's for people who don't trade futures, you can lose more than you have in the account. And his account was debit by a significant amount. He covered the debit, which we really appreciated in a timely fashion. He then put some more money in there and then could not trade many silver because we had raised the margins and wanted to complain about it and literally asked me, why have you raised the margins so much? And I'm like, your account was debit last week. And he says, yeah, why have you raised the margins so much? And obviously, the point is that, when silver goes from an 80-cent a day average range to, which is, $4,000 on a big contract, to $6, which is a $30,000 move on a contract, you need more money to hold a position in there. And the CME has done it consecutive days, and we have gone above the exchange minimums. But we had thousands of people trading it months ago, and now we're down to hundreds.
I was going to say, John, I don't think that diatribe, that soliloquy could have come at a better time. I think we need more soliloquies from brokerage firms and fewer. Sure, we'll fill your order. Sure, you don't need that much margin. Sure, it's all okay. So I'm really proud of you. I want you to know that.
Oh, appreciate it.
Good work.
Yeah, because it was the Thursday prior to the sell-off on Sunday night of the physical contract for silver.
Mm-hmm.
It was, our margins went from 11 to, or not, somewhere in that handle to 40,000 in about 5 days. So.
Yeah, you're not going to get as many silver bugs with that kind of margin.
No, the only people that are doing that are those, old LME traders, that are holding tin and lead and, those high margin metals.
Yeah, so it's not, so they're no longer the mini metals anymore. We're going to have to let the maxi metals for silver because
the big metals.
The big metals. Yeah, so we're going to have to figure something out with that. Mega metals, I like that one. I like that one.
I do like the mega metals.
Even 1,000 troy ounce contract. I think that's around $7,000 these days. So
wow, something. Yeah, that is something. All right.
My question is, what did Troy do to get an ounce named after him? You ever wonder that?
Yeah. Well, who is Bob, and why does he have gas? That's what I want to know. But on that note, let's proceed into the VIX. Seabass, what are you seeing in the world of the VIX today?
You know, it's interesting. Everybody's going to talk about how vol was down today. Vol was down yesterday, even though the VIX was saying it was up. It was really interesting, and, you know, Mark and Mike and John, tell me if you saw this too, but I'm looking and I'm seeing the VIX. We're down 17 handles, 18 handles. The VIX is only up, you know, $1.40. And I'm looking at strike vol, and across every single strike in the SPX, implied volatility is down. Then I pull up silver. Vol's down in silver. Then I pull up gold. Vol's down in gold. Oil. Vol down. I mean, every major contract saw implied volatility plummet yesterday in kind of relative terms. It was really kind of eerie. I don't know what the deal was, but, you know, I guess it's one of those, you know, that decoupling was a good thing. So.
Most definitely. Now, how frequently would you say you see a lot of things like this, to where you see all the strikes across the board on the S&P and the VIX just kind of having that relationship?
It's really weird. That was really weird. You know, Mark, I mean, did you kind of see the same thing? I thought it was really odd. Speaking of which, Mark Longo's with us now.
Mark just couldn't stay away.
I was waiting for my official introduction before I jumped into the fray there, but I didn't want to stomp all over Mr. Tusaw's excellent job hosting. I am just extraneous at this point. He is fully taken over the hosting chair. But yeah, you know, my perspective has been a little bit skewed for the past few days because I was traveling in transit most of the day yesterday. I'm not sure some of our listeners may be aware, but the bulk aren't, that the big options industry conference, OIC, is happening right now down here in Savannah. So I have been literally all day in a room in my little recording studio here, one person after another. The heads of the various exchanges, the heads of the brokerage firms, the heads of the major vendors have all come through our little recording studio here, and I've been having a great cross-section of the industry kind of to talk to. It's been fantastic, and there's a lot of interesting stuff going on. Obviously, the big 800-pound gorilla is all the exchange M&A and who's going to buy who and who's going to buy what and who's going to do what. And now other exchanges are suing some. I'm not sure if you guys saw this, but long before, I think in the last couple of days, that Box just announced that they're suing SIBO and ISE, and I believe NASDAQ is the third one, for stealing their PIP, which is, of course, that price improvement mechanism that the retail has been using for a long time. So there's a lot of heated stuff going on behind the scenes, a lot of the mechanics of what's going on in options, and a lot of interesting debates, actually, about whether or not, and I'm sure John will have an opinion on this as well, but whether or not the way that the options market is going and the way the exchanges are going with incentivizing a lot of these new types of liquidity, like high frequency, and moving data centers to New York to cater to these guys, and doing a lot of other things that are essentially, short-term gains from a volume perspective, but whether they may not be long-term very misguided for the actual options market and for the business in general. I mean, the bulk of our listeners are still, the hardcore of them are the high-end retail, and we're starting to slowly hear complaints from them that were the same things I used to hear from 1,000-up institutional guys a few years ago. They can't get trades done. They can't do anything with multiple legs. Bigger than a 10 lot is hard to execute. Fragmented liquidity is starting to hit them. So that these things that used to be 10,000-foot problems are now suddenly the domain of the typical retail guy, which is why I think stuff like this conference has had so much resonance. And we also, if listeners are interested in actually hearing what these exchange heads are saying and all their various debates on the panels and things like that, we are the exclusive provider for all of the panel audio down here. So you can come to the Options Insider over the coming weeks, and we'll put out all of the panel audio. That stuff usually is enormous for us. It goes to the top of the iTunes charts all the time and stays up there for a significant amount of time, which also belie to the fact that retail is not interested in this stuff, because I would consider iTunes to be a predominantly retail audience, and yet they eat up things like OTC credit default swap clearing panels, and for years this stuff stays on the top of our charts for ages. But that's what I've been up to lately. So my perspective has been a little bit skewed. I didn't have a chance to even put together the unusual activity for today, which is why Mark Sebastian has gracefully taken over that duty for me today. But it's been a fun one nonetheless. So some great perspectives on what's been going on in the world of options.
You're right. That just shows how far we've come as retail traders. I mean, it's amazing that like you say, that there's that much interest on iTunes for things like this. It is awesome.
Well, a lot of this is starting to affect the retail audience. You know, there's so many of these exchanges, and you know, it used to be when you had just kind of the big five that anything under a 10 lot got a really decent fill, and it wasn't until you got to kind of big orders. Now we're starting to see this stuff really affect the individual retail order. All this exchange gaming and everybody going for this flow and that flow. I mean, it's really bad for just about anybody that's on the customer side, what's going on in the option industry, at least until we can get things really consolidated. I know it's weird to say, but this is one of the things where less is more. You know, I think less is going to be more here. 3 or 4 or 5 exchanges, not 10 or 11 or 12. You know Mark, you don't need a free-for-all.
You must be seeing a lot of this with your customers, because I imagine a lot of your mentees and clients are on the higher end of that spectrum, and they want to execute complicated multi-leg transactions. You must be hearing a lot from them that, you know, we can't do this, or it's hard to execute this, or how do I get this trade-off in this fragmented environment? Yeah, well,
I mean, I think just about everyone has seen a drop-off in their fill relative to their working orders, where the stock price is. And that's caused by this kind of bribery payment for order flow system. And it's, you know, where orders are going, everybody's paying off everybody. And the only person that gets screwed is the customer. My clients complain about execution more than I've ever heard. I never heard retail people complaining about execution, and then in the last 6 months, it's kind of blown up. So
that's funny. I don't get those calls here at Options Express. I don't know what we're doing right.
That's funny. My clients that use Options Express never complain about it. It's true.
No, you're honestly, if you're having a problem getting stuff executed, honestly, we do have some top-notch execution. I mean, especially when it comes to stuff like futures options, you can do, you know, ratio spreads on our site, which I don't see on any other site. But you are right. Less is more when it comes to exchanges. Like Mark had brought up, that new exchange was going live, I think, in the next few months. He's got SEC approval. That makes 10. The word on the street is they'll never make it anyway. So maybe that's a good thing.
Yeah, they're kind of an interesting beast to talk about as well.
Yeah, time will tell with that. But with that, we're going to wrap up the trading block for today, and we are
exchange politics block.
The exchange politics / trading block for today, and we are going to proceed into the odd block.
The odd block.
And welcome to the odd block. This is where we talk about stocks that have a little bit of unusual activity in the day. And fittingly so, we wanted to give special assignment on the odd block to Mr. Mark Sebastian, the oddest trader of them all.
I love it. So the first one on the board is American Electric and Power Company, AEP. And this is a stock that normally does about 4,600 contracts a day. Today it did about 9 times that volume, coming in around 35,000. And a ratio about 3-to-1 calls to puts. And it was all bullish. It was, the customer came in, bought the May 37th, May 38th, June 37th, a lot of the June 38th. And actually, once May and June got overbought, the guy came in and bought the August 38 calls too. Vol got way, way out of whack. Now, eventually, and here's the reason why we saw that put-to-call ratio not crazy out of whack. Somebody came in and sold the August 33 puts too. So almost an all bullish paper today in AEP. You know, I actually wrote about this one for the street today. The trade I liked before the August went up was right now, and actually still, June is trading at a several percentage point premium in vol terms to August. So if you want to follow paper but take advantage of the vol differential, I thought a bullish calendar. So the way I wrote it up was, how about the June-August 39 call spread? And for 30 cents, looks like a good trade so far. I'm kind of a fan. So that is number one.
It looks like there was some takeover chatter. I guess there was some continued takeover chatter in that one. Obviously, hence the explosion of one-sided paper.
There you go, takeover chatter. You know what I think of takeover chatter?
Tell us what you think of takeover chatter.
Usually amounts to nothing. So, but I'm glad I did the 39 spread then instead of the 38. So, now the next one up, and this one is actually pretty easy to figure out. R.R. Donnelley. You guys might have heard of them. They are a pretty big publisher. R.R. Donnelley and Sons. And guy came in and sold 32,000 of the September 20 puts at $1.15. RRD's trading around 20.40. Looks like the guy was just looking for a way to sell some premium and doesn't mind buying Donnelley for $19 or $18.85. You know, your kind of basic bull play.
Basic bull play, just in amplified size.
Yes, it was a huge bull play. And then the last two here, HOV. Okay. You know, when I saw it, it's called Hovanian. I assumed it was run by Jay-Z, but it's not. Hovanian Enterprises Incorporated. It's a trading $2.50. Thought this was an interesting one. Guy or girl, apparently willing to buy Hovanian between now and 2012 for $2 or less, because he sold the Jan 2012 2.5 puts 19,000 times at 50 cents. Looks like the guy
19,000 times.
Yeah.
That's fantastic. That's the kind of perfectly ridiculous paper we love to talk about.
I know. And that adds to the 30,000 he's already got on. So it was a beautiful trade. So yeah, maybe that was Jay-Z for all we know. I mean, he does go big. That's my understanding. And then you know, just kind of off topic, NVIDIA just announced earnings after the bell.
How were they? Yeah, I don't have my live vol up, so I can't follow them actively.
It's trading up about 25 cents. So
okay.
If you were a premium seller, apparently you're a happy camper right here. And you know, we saw a ton of activity today. How many? You know, almost 2 times normal volume with a huge ICE sentiment and a lot of net premium bought. People bought about $800,000 worth of premium today in NVIDIA. So that's a lot of premium. It's actually 800,000 times 100. So that's a lot of premium. So
we've been playing around a little bit in NVIDIA over the past week. I believe I have to look it up to see exactly what we have on. But I believe it's the 1720.
The 1720 strangle. Yeah, that should collapse at this point. You know, there any vol. I'm looking here, and boy, vol was pretty elevated in this thing. Came off a little bit today, actually, but we saw vol coming in at about 58%, 30 days out. You know, that's a nice chunk, and so I'm thinking tomorrow you should expect to see vol in at least 10 points. You know, these 30-day vol charts are a lot harder to use now that they've got these weeklies. I keep saying this, but you can't really look at earnings the same way as we used to because people aren't playing earnings in the regular contract month. They're using
it's all in the weekly.
Right. And rightfully so. Why wouldn't you?
Well, yeah, I mean, you want a little room. It's a little wiggle room. You know, when I like an earnings play, a lot of times I like to play in like June or September.
Really, that far out?
Yeah.
For like a 2-day earnings move?
Yeah, like if we had earnings today, I would probably be looking at June, because usually, and maybe I'll sell something in that front month, but when I'm buying premium, I'm usually going to those back months, because they, especially with the weeklies now, there's usually almost no juice in them relative to just normal vol at this point. I don't know if, Mark, you've noticed that, but there's just nobody is buying the regular months anymore when they're playing earnings. So you can get some plays pretty cheap.
Yeah, if you're going long premium, you can roll out a little bit. And on the converse or the inverse side of that, I think we put on this strangle in the weeklies precisely because that's where the bulk of the activity has been, and that's where the elevated volatility levels were. So it seems like if we wanted to go short those strikes, that was the optimal place to do it. But you're right, there isn't much wiggle room in the old weeklies. It's kind of a do or die scenario.
Yeah, it's a double or nothing trade. You're either right or you're wrong.
Mm-hmm.
Exactly.
All right, then that will conclude today's odd block. And now let's move on to the express block.
The Express Block, brought to you by Options Express. Options Express lets you trade where and when you want for every level of trading. From advanced charting, free daily trading ideas, and free educational resources, Options Express is the online broker for all traders. Best of all, Options Express allows you to trade stocks, options, and futures all in a single account on powerful yet easy-to-use trading platforms, including mobile devices. Visit optionsexpress.com/OXradio for your free account. Options Express is a member of FINRA, SIPC, and NFA.
And welcome to the Express Block. This is where the 3 M's of the show, Mike, Mark, and Mark, get to sit back and listen to the wise teachings of Mr. John. John, what do we have today on the Express Block?
Well, I know we mentioned silver, so I'll try to skip over that and maybe come back to it later. But a couple of things that, usually when I get the enjoyment of talking to some of our customers is usually because they're upset about something. And one of the things that popped up this week had to do with Citigroup. Everyone knows they went on for a 1-for-10 reverse split effective Monday. So I get this question a lot when you get a split. We get a guy here that's holding roughly 200 contracts of the May $6 calls. And he says, well, why don't I just go ahead and exercise my calls? I can take 2,000 shares because, they're not delivering the 20,000 anymore. He gets 1/10 or 10 shares per contract deliverable. Why don't I take my 2,000 shares at $6 and then I can go out and sell it at wherever it's trading at right now, around $42, $41. And a lot of it's funny, but it lets you do a lot of these non-standard options and what happens when you exercise them. This is an easier one, obviously, but I've seen ones where you get partial shares of certain other companies and you kind of got to write the math out. But I had a couple of my brokers struggling with it too because they came to me and so I sent out an email. I'm like, tell me, I send it out to the group. Tell me why you wouldn't want to do this. Well, the big thing is the multiplier doesn't change. So he's going to spend $120,000 to buy 2,000 shares at $6. And if you just 2,000 shares divided by your cost of $120,000 puts your cost basis at
$120,000, right?
Well, yeah, divided by 2,000 shares, his cost basis is $60. I mean, that's basically the option.
Gotcha. Oh.
Yeah, but if you want to spell, the customers, you kind of have to show them step by step, why this is a bad move for them.
Hey, that June 4-half straddle we were talking about is looking pretty good right now.
Yeah, no, that's looking real good. I actually had the 4-half straddle on. I killed my calls at 5 cents and have been running the puts down, and then was buying different regular contracts incrementally and selling those when they turn into 100% winners. So Citigroup's been good to me the last couple days.
Yeah, Citi's been good. I mean, I've been traveling, so I haven't really had a chance to manage our stuff, so we're still long the call portion as well. But we had the calls initially, then we legged into the puts, and then we just to accentuate the straddle, and it's worked out fairly well.
Mm-hmm.
Yeah, what's it down $4.50 since the split, since Monday? I mean.
Oh yeah, no, well that was the low. I think it's only down about 3 inches.
2.5 now, yeah.
Yeah, but what a piece of junk, people. I mean, I'm sorry, but it's going to go to 32 before it finds a floor. So.
I mean, over the last year, this is all I've been seeing. I want to buy the leaps in Citigroup for the Jan 5 calls. You know what I mean? It's just over and over and over and over again. So, we can't recommend stocks like Tucson and Know Your Options, but I was agreeing with you on the junk stock, but we can't tell people to not buy something, but kind of tell them why they're.
You kind of just did though, didn't you?
No, he said Citigroup is a junk stock. He didn't say don't buy calls or don't buy puts.
Oh, a big difference.
Exactly. I can't say that it's a junk stock. I'm not saying, but the amount of people that came in and were buying $5 leaps were endless. So, and it did pivot around there for quite some time, and then when the split came, it's just going down. But then the customer comes in, why can't I just buy these for a penny and exercise them? Well, there's your answer, because you're buying 15. What are we at? 40. What did we close at? 42.40. You're buying an $18 out of the money call and exercising and giving up all that cash. So don't open positions in non-standard options, especially Citigroup calls these days. Another call.
I love how people think that the market is that stupid that they can buy these calls, exercise them, and make $1 million. What is wrong with people?
Yeah, I've literally had people say this is a win-win situation. You ever see like the SPY, like a spread trading more than its difference in its strike price, and I'm like, well, there's a 60-cent dividend coming out tomorrow, right? And they're like, oh, I'll talk to you later. They never get to thank you, just to click.
Yeah.
Or then the other one where they're trying to short stock, where they can do like the reversal, and they think that it's like a guaranteed 6% over a week or something like that. Have you had that one in the past? And there's a dividend.
We have, and that's kind of rolling into my next thing. You're talking about like selling deep in the money calls and buying puts.
Oh, like when you short the stock and then sell a put and then buy a call to protect upside, all at the same strike price.
And you net like 8 cents or something like that.
Yeah, and then there's a dividend that you're going to end up. And
the other risk too is being assigned on a hard to borrow stock and then getting bought in at the market too, and not being able to realign your position. That's what I was going to talk about too. Is that a lot of the times I'll have to talk to people because of shorting stock and the buying procedure, and then we have a lot of people that do that with that strategy that you were just mentioning. One thing I want to mention is that when you're shorting stock, it's not like futures. You can't just continue to short as much as you want, because when you're shorting stock, you're borrowing from somebody who's long the stock. We get a lot of requests on the site for hard to borrow stocks. We go out and borrow them on the street. And when we borrow from the street, we pay an interest to borrow them that we absorb internally in the firm. We do not pass it along to the customers, which is a good thing. The bad thing is that when we borrow from another firm and they tell us that we have a buy-in notice, that we have to go in and close out a short position in a customer's account, it usually doesn't lead to a pleasurable phone call when we're talking to these customers. No, not at all.
No.
One, it's always a loser for the customer because it's always running up in their face. And two, when you're buying it as a market order, you're getting a bad fill because of the wide spreads and the volatility of the open of the markets. And three, nobody ever wants someone else other than them, trading in their account. But everybody knows the SEC has been very strict. I think they actually came out with some new rules recently about the uptick rule for stocks that are down more than 10% in a day. So if you are looking to short stocks and it's down 10%, I believe they have an intraday circuit breaker that kicks in, and the old uptick rule that they pulled in 2007 goes into effect. I was reading an article on it yesterday about it, and I guess there are a large amount of stocks that do hit this 10%. I think they had about 80 or 60 to 80 roughly a day, but it happens to be these stocks that nobody ever hears about, and most of them trade below $5 anyway, and we don't allow shorting on $5 stocks or stocks that trade below $5. So those two things, Citigroup and short selling, I don't know if we had a lot of buy-ins this week, but I had a lot of pleasurable phone calls on those two subjects.
It sounds a slight tone of sarcasm when you say pleasurable, but
I don't get to I don't get to take any friendly calls. We don't have enough clients that are calling in to say what a great job we're doing. We do get them, but they're far and few between. So if anybody has a pleasurable experience at Options Express, wants to ask for me, and I'd be more than willing to take that.
You got to go to the Options Express events. If you go to the Options Express events, 99% of the people there, you get that. So I guess that Cusick and Nina and all the education gang, they get all the good ones and they stick all the bad ones to the trading department.
I think that sounds about right.
Yeah, I don't see anybody get elevated up to you, John, just to say, you know what, you're doing a great job there, sir. So yeah, listeners, give John a call, give him a nice little pat on the back. He's getting kind of sad and lonely over there.
Yeah, he is.
If you get if you get good service from a broker, yeah, be like, let me talk to John. I want to let him know. You know, the broker gets some cash and.
Well, you can see you can see the tear stains from John on his steering wheel when he gets out of work and he cries in his car by himself.
And I get home, my wife goes, another one? Another bad day. Nothing nice to say.
Exactly.
That's good.
No, it's trading. It's like baseball, right? There's no crying in baseball. There's no crying in trading. Especially self-directed accounts.
That's right. Amen, brother. Well, that will wrap up today's Express Block.
Welcome to my world, sir.
Let's dive into the Viewer Mail Block.
Listener mail. Listeners write in.
Mail's in.
Mailbox.
And welcome to the newly installed today Listener Mail Block. Today we have a couple of listener questions that we wanted to read on air and just kind of talk about them a little bit and just kind of give you guys some feedback as to from what we are getting. The first one we have comes from Ryan. And Ryan has a question. When do you think the options exchange will offer extended hours trading? It seems like this would make sense considering the events that take place before and after normal market hours.
You know, I sent him a response, but I thought it was an interesting one to put on the air, too, because we get similar questions like this on a regular basis. You know, we used to see a lot of this push, you know, a while ago, back when I was still on the floor for the extended hours stuff, and we saw a lot of pushback from the market makers and liquidity providers who didn't want to staff up to have extra personnel to come in to trade the same products for a couple extra hours. So that seemed to have killed it. We're probably due for another push of this interest. I have yet to see anyone really make a concerted effort on it, but it wouldn't surprise me if in the next couple of years we start seeing some movement toward that, even though it will be an even additional strain on the existing trading and market-making firms out there who are already getting strained pretty hard.
Yeah.
Yeah, I think that'd be pretty interesting to see, like, during the earnings announcements, just seeing
Well,
people...
the markets will be so wide. If you're trading after hours, if they do that, at least the first year, that's when everybody's going to make their money because they're just going to rip everybody off, to be honest. You know, the markets will not be that tight in after-hours trading. And if the stock market is wide, how wide do you think the option markets are going to be? They're going to be insane.
Well, I agree, but I mean, like, what about in situations where you have a highly liquid stock that is fairly narrow after an earnings announcement or something like that?
Yeah.
With something that's narrow, no doubt about it. I wouldn't touch any after hours option trading even with Sebastian's account. But if it's
appreciate that.
Oh, well, thank you. But if it's like something very liquid, like right after Google or Apple announce earnings, where it's pretty narrow bid-ask spreads on the stock, then I would think there might be a decent market for something like that. Wouldn't you guys agree on something like that?
Yeah, a good example right now, like, you know, we were talking about NVIDIA earnings. We have that strangle on. You know, I can go hedge it in the underlying right now, but it'd be nice if I can go and just take off the option portion if I wanted to as well, you know?
Yeah.
You're limited in your utility and your choices right there because you have to play with what's available.
Yeah. That's good. It's an interesting comment. Thank you for your question. Next listener question that we have comes from Dave. Dave tells us, hello, everyone. I was curious whether a strategy that I recently concocted would be viable, profitable, and not take unnecessary hidden risk. It goes as follows. Screen for volatile stocks with high volatility premiums in the options. Companies that have volatile stocks but not excessive risk of permanent loss of capital make for the best selections, i.e., not healthcare stocks with binary events in the near future and not small cap stocks that may be out of business in 6 months' time. Strategy. Buy the stock, sell an equivalent number of at-the-money calls for the shortest date at expiration. Regardless of how the stock and options do at expiration, roll the strategy forward into the next closest expiration. The strategy works because you collect the premium on the options month after month. The way the stock moves is pretty irrelevant because the calls are rolled forward to the nearest expiration with the highest call premium month after month. We have a trade example that he gives us here, eBay. The price is $34.25. And the option, the May 11 call, or the May 2011 call. Strike price $34, so right at the money. Premium $1. Days till expiration 31. Annualized rate of return. He writes in the formula that he's getting here in terms of if you were to get this all the time, 52% based upon a 21-day risk. Sounds like a good rate of return for limited risk. Who cares if eBay tanks 50%? You take the premium to make up for it. If it goes up 200%, well, you missed some upside. And eBay is not likely to go under in the next few years. Any thoughts on that? I love this, but I will give it to you guys first.
You go ahead, Uncle Mike. This is what we're
this is perfect. This is perfect for you, Mike. This is the Tucson wheelhouse. All right, this is the linebacker is trying to hit. The linebacker is trying to go in and tackle your running back, and he doesn't see you coming in on an angle block, and it's about to get completely leveled. That's what you're about to do to this strategy.
I think it'd be more polite coming from you, Mr. Tusa.
Okay. The thing that I would have to say on this one, I thank you for the question. You can tell, Dave, I can tell you're doing a lot of research on this, and I think I like what you're doing with this in terms of with everything that you've looked at on it. But one thing that I would say, let's say eBay does go down 50%. And then theoretically, you do the same thing with, we'll just call it XYZ stock the next month. That's also at $34 a share. Well, if that's the case, what if that stock goes down 50% the next month? With that, you're just down over 2 months, 75% of your capital. Now, let's use some math here. Let's say that you did that, and let's say your strategy works. Let's say that you do make money enough to where you take in enough premium. You started with, we'll just say $100. For every $100 you had in the account, after 50% down months, you're down to $25 in the account. Now, in order for you to get back to even, you're not going to have to go up. You're not able to just make it back by going up 50%. You're going to have to quadruple your money. And let's say that you do just go up 50% a year. And by the way, going up 50% a year is not an easy thing to do in this business. I don't know of anyone that's ever consistently done that. But with that, let's say that you do. You have $25 in your account. We go up 50%. Following year, you're at $37.5. The year after that, you're going to be above $50. Year after that, you're at 75 about, and then maybe the year after that, you're back to even. So 2 bad months are going to set you back 4 years, and that's if it works every time. Every month, you're going to have 48 winners in a row for those 2 losers if that's the case the first month. So the concept of it I like, but I would have more risk management in it as opposed to if it were to go down 50%. So those are my thoughts on it.
Yeah, Tucson, you'd be buying a put there too, right?
Oh yeah,
collar trade.
Yeah, a lot of times with collars, absolutely. I mean, if it's one where I don't buy puts on everything that we have our clients in, but I would say probably a majority of our equity exposure is covered with puts. I would say that not all of it, but a good chunk of it is covered with puts. And there's a time to where it makes sense not to be hedged. I mean, if you hedge everything, it's like buying a zero deductible insurance policy. The only one who's going to get rich is the insurance company. But if you just what really scared what I didn't like about this strategy, Dave, was that your risk management side of it, you're throwing caution to the wind to where even if it goes down 50%, who cares? Well, that's my major concern on the strategy itself.
That's always a clue when someone says they're not concerned about the major swings in the underlying. We get a variation on this quite a bit as well, and it's someone discovers a new strategy for the first time. And granted, Dave did a lot of homework on this, but we see this a lot with people who discover buy rights for the first time. This is a fantastic strategy. Why has no one jumped on this before? It's the same thing we were talking about before. There is no free lunch. In this kind of scenario, to be up 50%. You're clipping all of your upside because you're writing ATM calls on this, and so the ability to be up 50% in this strategy is extremely difficult.
You're going to have 48 winners in a row to make up for 2 losers.
Exactly.
So, But anyway, the last one we have, this one was actually, for me, it's not in the email that I'm looking at right now, but I remember we had looked at it a little bit last week. It was a little bit about my story, and that I'm the only one on the show that's never really had any experience in the trading pit. And how did I go from being on the Buffalo Bills to being in the option trading world? So I want to talk about that a little bit. I got cut from the Bills in 2000 after the third preseason game, and I always
you walked away of your own volition. Don't say they cut you.
Yeah. Oh no, they cut me.
Modest.
They cut me. It was I was behind Reuben Brown, a 6-time All-Pro. It wasn't happening. So, but with that, I got cut, and in that time frame, I was still pursuing the NFL dream, and while I was doing that, I was substitute teaching as a means to pay my bills in the meantime. And so as a substitute teacher, for anyone who's ever done that, you know that you have to be a royal jerk to the kids or you're going to get walked on. That's just the way it is. So what I would do, being 320 pounds at the time, I would get at the front of the classroom, say, sit down, be quiet, do your homework right now. And then I would magically get about 50 minutes of silence every class period. So during that time frame, I read pretty much every option trading book known to man, and that was probably the main way that I learned about options. It was a whole school year of just 6 hours of reading per day, and then eventually, as time went by, I'd get in trouble for trading in class. And then they blocked my Options Express account. They blocked out the Options Express website in a lot of the classrooms that I was in. So then I'd go onto the SIBO and get delayed quotes. But it was quite the interesting way of breaking into the business, let me tell you. So once I had already gotten cut from 5 other teams around the Arena Leagues, the XFL, and a bunch of other places, and realized that Arena 2 football was not for me, I decided I just wanted to start trading. And the worst thing that could have happened to me. I was pulling in 20% a month trading credit spreads. And it was horrible. And the reason it was horrible is because I thought I actually knew what I was doing. And things were working great for me. I'm thinking, well, forget this getting a job stuff. I'm just going to do this. And then a worse thing happened. I started legging into credit spreads. I would be naked the put for a day or two. And you know what? I can get a better fill if I'm naked the put, and then let the stock go up a little bit, and then I'll hedge it. That way I can get a way better return. And I'm making way more money now. And then an even worse thing happened to me. I was making more money doing that. So eventually, you guys know what the end of this story is going to be. I learned what... I retired at age 24, and now I just do this for kick. No, just kidding. I learned what a pharmaceutical downgrade is the hard way, basically. And so I didn't lose all my money, but I lost about $6,000 one day, and I realized, you know what, there has to be a better way of doing this. And so I pulled out, and I totally quit trading for a brief period, and got into the business, eventually hooked up with Options Express, and then throughout time, I came up with my 3-prong approach. I have the long-term investing approach, which is how I invest for most of our clients today, using options and this is what I developed through my many years of working at Options Express in my own account. And so I've kind of brought public since I've been with Know Your Options. And I have the income section of the trading account, that's where I'm going to do condors, butterflies, and higher probability trades, but with very much risk management. And then the have a hunch, bet a bunch section. And I do maybe one trade like that every year or two, if that. And that's something to where I'm going to risk maybe a couple $100, if that. And so with that's how I developed my strategy through many years of actually doing it. I had a lot of great mentors throughout time. I've got to meet a lot of great people in the business, and it's really worked out well. And so just to give you an idea of it, when I applied for a job at Options Express, it was one to where I really just lucked out in the interview, and thankfully Ned Bennett was interviewing me, and he had asked if I had ever played football before, and I told him yes. And for those of you that don't know this, Ned Bennett used to play football at Ohio State for Woody Hayes, and I think that's kind of what got me the job, is we had that football bond, and it worked out well for me. So that is my story.
I'm glad you brought up Ned
for all of this. Yeah.
Yeah, Ned's the one to blame.
Every time I talk to Ned, he has a football analogy, so I'm glad you cleared that up for me. I'm like, this guy's either a huge, football fan, or he's played professionally, or obviously in college now. But everything is an analogy about football, so which is relates to a large portion of the industry.
Very much so. So,
Good story.
Well, thank you. So on that note, we're going to wrap up the listener mail section. And now let's go into our Around the Block section of our show.
Around the Block.
This is when we ask everyone, what are we looking at in the coming days? Steve S., what do we have going on over at the Option Pit, or what are we looking at over at the Option Pit?
Well, we're still finishing up earnings. I'm watching kind of the VIX. I'll be real interested to see kind of where vol goes. And, of course, obviously commodities. Just looking at things, I feel like silver is at I don't know about you, but I feel like some of these commodities kind of finally found a floor. I think we've kind of forced everybody out that wasn't for real. And I do think we're near some sort of short-term floor. What about you?
Well, I'm adding deltas on the silver side of it right now. I mean, I'm keeping hedged for the short-term trader gibberish or whatever. As of last Friday, we've added deltas to our silver position. We're hedged from 33 right now. It's just that we stayed. My rule was that as we got below 40 on the silver side of it, I had every intention of rolling down the puts, but we just kept going down like a rock. So I'm like, well, you know what? I got to have at least one up day before I do this. And Friday we had a little bit of an up day, and so that's when we added some deltas to it by rolling down the puts. So, Options Express, John, what are we looking at over in the OX world?
Well, today is day one of Forex. We just invited 50 current clients to become pretty much beta testers for our Forex, and here's the start of a long process. Hopefully, we get a good response rate from them, and they can tell us what needs to be changed. We've been planning this for about 6 to 9 months, and today's day one, so that's going to be the focus for us going forward. We're hoping this is a profitable and successful venture. It seems like a lot of the broker-dealers out there, the ones that we compete with directly, have been offering it for 1 to 2 years. So I think it was natural that we just got into the arena as well. But, pretty much that's, last 2 weeks was our focus on training. We're rolling it out today. We're pretty excited about it. So that's what we have going on at Options Express.
Sounds good. Mark Longo, it's your show, so I suppose we ought to ask you what you guys are watching over at the Options Insider.
Well, we've been curtailing most of our things ahead of our big OIC explosion down here. We knew we wouldn't be at our screens all day, so we didn't want to have too much on. In terms of, obviously, we talked about NVIDIA. We had some Cisco as well on the short credit spread side, and then we had, that looks like it fared fairly well through the old earnings cycle, and the nice long premium position going to work for us out on the June 4.5 strike in good old City. So that one can take Grigas' nice tumble down to 25. We wouldn't be averse to that whatsoever. Okay, so yeah, that's about it for us right now. We're still mostly in conference mode for the rest of the week.
Sounds good. Well, that will conclude the Around the Block. And as always, we'd like to thank all of our usual cast of characters for coming on the show. Over at Options Express, John, I know we have some events coming up in the educational world. I know that the Options Express Roadshow with Jim Roseanne, the ladies' man, is traveling around the country. Where are we going to these coming weeks?
I know we had Chicago at the end of April. I tried to get the word out about that. May 14th, we are in Charlotte, North Carolina. This is a free workshop. If you're an account holder, you can simply go to Educate Events and register for free right on the site. Also, they're going to be in Columbus, Ohio, May 21st. So those are the upcoming ones. I think long term, we're looking at some West Coast ones in San Francisco as well, but those are the near term ones for me.
Over at the Option Pit, what do we have going on over there, Mr. Sebastian?
We've got a couple of things, but the big thing is I'm doing a free webinar next Wednesday. It's on adjusting butterflies. It should be a lot of fun. So go to optionpit.com/events, and you can register for our free butterfly adjustment webinar. I went and did last Saturday. I did a presentation on how to trade the VIX with the CBOE, and I want to thank everybody for the support. We had an incredible turnout for a Saturday. The webinar or the seminar was great. We had a bunch of people listening in online. I don't think it could have gone much better. So, and I could have done without all the option insider support. So it really went well. So
hey, we try to send people the right way, and that's what we do here.
Mm-hmm.
Send them to the good stuff, and sometimes you send them to your stuff too by accident, but that's just how it works out.
Exactly.
There we go. Mark Longo, your show, your plug. What do we got going on?
Well, yeah, I don't usually plug myself when I'm hosting, but we do have a lot going on this week. As I mentioned, this is the big options industry conference week. This is our big blowout explosion of our flagship show, the Options Insider Radio Show. We do bring on all of the CEOs of the brokerage firms, the exchanges, the vendors, the trading firms, you name it. If they're related in options in some capacity, they're coming through our studio this week. So it's really just an explosion of content. In addition to that, we also have all of the panel audio from the OIC conference exclusively on our site. All this explosion of content will be coming up in the days and weeks subsequent to the conference. So stay tuned to the optionsinsider.com, or if you're an audio subscriber, stay tuned to the iTunes feed. All of that content will be coming in there, and you'll be able to listen to the panels, listen to the sessions, in fact, we're recording an update session is going on right now as I'm speaking, and we're up there recording that right now. So there's a lot of great stuff coming your way. If you're interested at all in options and options trading, this is this is content you don't want to miss. This really is kind of a unique stuff. And so stay tuned to the optionsinsider.com radio section and to the iTunes feed. There's a lot of good stuff coming your way very soon.
Sounds good. And at Know Your Options this weekend, we are out for blood. We want your blood. Stop by Physicians Express at the corner of Route 64 and Randall Road in St. Charles, Illinois. We're going to be having a health and safety fair there. It's not a Know Your Options event, but I will be there giving blood. But stop on by. It's a great cause. I would love to meet anyone that stops out. And on Sunday night, I will be doing a webinar on ratio spreads. So for more information on that, Sunday night, 9:30, love to have you. Go to the KnowYourOptionsInc.com website. And that will do it for today's show. I am Mike Tusaw, your host. Very glad to be here. I must say, it's always a pleasure to try and fill the shoes of Mark Longo, but I know it's something that's never happening. It's very difficult to walk in these shoes, so I get a new appreciation for what he goes through every time I do it.
They are size 27, so they're a little hard to walk in. You're right.
And there we go. Thank you for coming, folks, and let's have a successful trading week.
Later, everybody.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.